right, question 3: how to manage positions in a rising volatility environment. So again, I'll let you kind of like read this as I get a drink of water. This is an interesting question. Obviously, it's a little, or it's very maybe reactionary to what's happening in the last week. As I just mentioned, volatility has significantly increased from kind of the low end of the chop bucket now to the top half of the chop bucket, with a rising probability of getting into the F bucket. I think it does kind of depend in terms of one, the question probably needs to be expanded upon a little bit so I can answer it a bit more poignantly or specifically. So, but it does depend. However, the best answer would be to raise cash. So anytime a rising and an environment of rising volatility is occurring, raising cash or selling down that piece of inventory makes sense, right? So when I say raise cash, it doesn't mean you have to take your entire book off, but again, if we kind of be a bit more specific in a particular asset class, if realized vol in an individual security goes from 30 to 60, so it's like doubling, you're going to be wanting to typically you'll want to be reducing your size of that position and take it from, say, a mid to min, and then potentially all the way off the book completely. Now, I say that, but you can also have rising volatility as price moves to the upside, and you can look at spot gold price in the last week with GVZ, which is gold volatility, plus 308 basis points on a week over week basis. So volatility does go both ways, and rising vol with a rising price can be a positive thing, but typically, and I think the way this question is being asked, it's more about kind of the snapback and the violent moves that you're kind of trying to track. My good friend Chris Moyer, we were talking earlier this week. He mentioned that that there's basically kind of rules of thumb, right? So at kind of a 32 VIX, you're going to get now I might be misquoting him, but I believe it was a 2 or 2.5% move in. I believe it's a 2% move in price, right? So if in the S&P, that's kind of a standard. At 16 vol, it's basically 1%. So anytime you get higher volatility, and again, regardless of what the actual numbers are, the point of why he told me this and why he tracks it and why I'm sharing it with you is that rising vol really means you are going to get those price swings, and you are they're going to go, it's going to be violently to the upside and violently to the downside. And again, that's one of the reasons where raising cash can be a very prudent measure and ties back into the core fundamentals of what we do here, which is preserve, protect, and then compound our hard-earned capital. So the key focus is preserving and protecting. So again, I just would reiterate those pieces, and anytime you've got a rising volatility environment, it's best to kind of try to sidestep those, and again, as I said, raise cash in whatever capacity that means for you.
Well, markets, I say this all the time. I mean, market crashes typically occur from oversold levels. Our definition of what is oversold is the low end of the range. So you want to be very careful on intraday moves. In particular, you should be watching where front month volatility is going. So one very obvious example is when you have something like the VIX go into the fuck bucket. Now, this is where new subscribers are going to get really, really excited, because this is a real important one. Currently, we have a risk range on the VIX of, call it, 18 to 24. So when the VIX goes like this, it constantly bouncing off this level, right? It goes into here, and the top end of the range of volatility has the low end of the range. The equivalent of that on the S&P 500 is 38.91 this morning. Okay, so if we were to see that 38.91 and a 24 VIX, I will be covering some. But if I start to see that sucker howl, you start to see 25, 26, and this is where I'll update you in real-time alerts. I'm like, I'm not covering some. I might even press shorts there. I definitely look for other shorts, because I don't want to take off my net short exposure. For the record, I just went from, so for example, yesterday into the close, I went from 13% net short at the start of the week to 3% net short. I took 1,000 basis points of net short exposure, and that's how I make money, right? That's how I pay to go to Cartagena. I don't go for free. Nobody's running my money, getting me that. So that's where you got to be very careful. Obviously, if this gets anywhere near 29.30, this thing's going to blow the roof off, and you're going to have down days like if you're new to this that you've seen before, but you probably weren't proactively prepared for.